Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, March 1st, 2019. Usually I like to do the videos if there's something compelling that happens intraday or just wait for an update, end of day update, particularly if there's any new developments in the market. So right now, not much. You can see as I'm starting this video here, it is 10:51 a.m. Eastern Time. And the S&P is up 0.35%, and that's SPY. But same story. But there are some things I want to point out. So first and foremost, just to do a very quick recap, this is again what I believe to be, and I think others believe, significant resistance. And so we're still below it. SPY made a little thrust up today, and I'll talk about that a little bit in the intraday charts and share my thoughts. But before we leave the daily charts, just a quick recap of what's happening, or at least some of the most salient points of this chart. And again, that would be the roughly triple top highs here, which is the top of that large, very large volatile range. After the top came, we had that consolidation period and then finally broke down below it. So technically that's significant. I think it's hard for anyone to argue that. The 250-day, some people use simple moving averages. Sometimes I'll put those up as well, but my preference is the exponential moving averages. These pairs have been watched for eons. And that is when you have the 50 trading below the 200, that is bearish. It denotes a bearish intermediate to longer term trend. And when the 50 is above the 200, the trend is bullish. So when you have a cross, which we did right here, right around here, that's a death cross. And from there, you can see, the market certainly took heed of that warning. And had that meltdown there. Now, whether that alone was the trigger or not, that doesn't matter. Just wanted to point that out. That what happens often when you're looking at moving average pairs, especially the longer term ones, the slower moving average, in this case the 200-day, will often act as support or resistance when tested from above or below. So right now you have the 50 coming up, so you can look at it this way. That, technically speaking, should be resistance. I'm going to try to, well, I don't have a line tool right now. I'm just going to put an arrow tool there right on the lines. So, and you can go back in time. It's not perfect, but you can look during uptrends. You'll see the 50 come back, sometimes bounce off the 200. I just want to point that out, that you have both the 50 coming up to test the 200 from below, and then prices recently failing or at least stopping, if you will, at significant resistance. And then finally, I've mentioned one of the things I like to watch here too are these what I call clean and high-level bullish PPO crossovers. By that, being a little picky here, let me grab another tool here, do a line tool, and tell you, again, when you're, trending or chopping around, they don't work as well. But when you have these big hills in the PPO, these are what I call hills, the PPO histograms, just showing you the differential between the two lines. The wider they are apart, the bigger the histogram. So this was a huge hill, and as I've talked about, the fact that the hill is getting smaller, these successive smaller, lower peaks, that's waning momentum, as I've talked about quite a bit. The strongest gains were right here off the highs into the peak on January 18th, and we had another leg up. Still impulsive, and then this one a little less. So again, it's the market's losing the momentum to the upside. And again, this is where bulls and bears can debate all day long. Bulls are looking for, I think, if I don't know. Somebody told me today, and not that it even matters. Some bobblehead on CNBC said the market can just melt up from here to new highs. Man, I wish I had that kind of optimism. I just see too much in the charts. I maintain that the risk reward, even if you're short now, we need a little bit more evidence to give you some pretty good sell signals. And I'll talk about those here in a minute. But I think you could be short. And worst case, you're going to be in a dead money trade for a while. I think at best case scenario, the markets would need to work off some of these overbought conditions, excessive bullish sentiment, to build up the energy for a sustained breakout above this level. I'm not talking a little pop that lasts a day or two, 1% or so, and then back down. I'm talking a sustained breakout that takes out the previous high. So those are my thoughts for what it's worth. And here we have the final thing I wanted to mention. The PPO histogram, as I told you, has made a cross. There's your bearish cross. Yesterday it was confirmed. Today, even with the market still up, we have a red bar. It means the PPO has crossed The fast line, the PPO has crossed down below the signal line even more. Now, why is that? Why, if the S&P is up and it was up even more today, would this histogram bar be red? Again, it's the market's losing momentum. We had a lot of upside momentum, and so despite the fact so far we're green, that crossover, that sell signal is still intact there, and the same on QQQ. Look at that, there it is, big giant hill right there. Biggest one in a while, means just long, clean separation. PPO rolling over and has just made a bearish cross as of yesterday, and that remains so today. So far, we haven't closed the day. Anything is possible. Can this prove to be a whipsaw signal? You go back in time, you'll find enough. There's one right there. There's a little whipsaw signal for you. So nothing set in stone, but again, you get a big hill like this with that waning momentum, these lower and lower peaks like that, and that's usually when you get the real signal that comes right there. There's your sell signal, and there was your correction afterwards. There was a big hill right there. There's your sell signal somewhere in there. There's your drop. 60-minute charts, more the same. It's like watching paint dry recently. I'm sure there's two schools of thought right now. Well, I know that just like from what I can gather in the trading room and just hearing other buzz out there. Let me grab a tool here. So basically, here's what's going on now. Since we popped above this level, really you can see right around here, particularly this part, we've just been moving sideways recently. So bulls are saying, and it's true, that market refuses to go down, but on the flip side, it's not going up, at least not recently. Now, of course, that doesn't mean that the bears win. You know, if you're long and bullish, or even if you bought here recently, you haven't lost anything. But then again, if you shorted, you haven't lost anything. So this is just a stalemate. Call it what you want. But there's some levels that we're watching. We're going to zoom in here, as I've been mentioning recently many times over. And again, in today's update, the pre-market, that one was subscriber only because I covered several different charts, but I also put up the futures on the indexes, which I'll cover again. I'm really looking for a break of Thursday's lows to spark a nice sell-off. But I can tell you there's some levels here I'm watching. And more so, here's where I'm going with this. I think today, if we see the markets go red and are poised to close red later this afternoon, and you know, to use some slang here, the redder the better. In other words, if heading into the afternoon session at 3 o'clock, 3:30, we're down 0.5%, even better, down 1%. We see a big fade. To me, that would be very bearish, and that's just a big if right now. To try to call such a fade is tough. We've already seen a fade. Here's the gap. I'm just jumped over to 1-minute chart, so you can see the S&P 500 was up. We gapped up high, real strong, about a 0.68 gap. We were up about 0.8%, and since then we faded a good part of that gap. You can see better than half of the gap was already faded. So that tells me a couple things. Number one, we failed. They tried their best, whether it's the algos, whether it's just the powers that be, whether it's natural buying and selling forces, supply demand. It failed to pop that resistance level that we stalled at on Monday. And so far we're down below it again. So, and it came really close. You can call that a second test and a second rejection, if you will, off that level. But again, the markets are green. What I continue to say, there's a lot of angst among traders in the trading room that have tried to short this market in recent weeks because of these intraday rips. I don't get overly concerned with the intraday rips. Let's see how the day closes. So far, we have yesterday was the third day, first time since the markets bottomed on December 24th. We had 3 consecutive red candles in QQQ, meaning SPY, the S&P 500. 3 consecutive red closes. Not a big deal because they weren't big red closes, and I don't want to make too much of that. But if we see another red close today, what it's showing me is, people are stepping in to buy in the morning, and that buying is being met with even stronger selling. You can see what happens. The sellers stepped in to fade that rally, and my guess it was more of longs selling their long positions, taking profits, than shorts coming in. Shorts have been beat up lately. And my guess is they're going to wait for a little more evidence. So where I'm going with this is I think if today, here's a little midday consolidation. If we break down and we go red, that will be, first of all, one heck of a fade. Number two, it'll be a pretty bearish red candle. Just flip back to the daily charts and try to imagine what a red candle, let's say we close the market down, let's say 1%. This green candle right now, which hasn't been finalized yet, would turn into a big red candle, and that would has a possibility. Again, depends how red we go, to engulf. And this is a warning that I'm giving right now. I've seen markets like this, and I know that I've been stating a clearly bearish case right now. And here's the thing: if you don't believe it, don't even listen to these videos. But I've seen this happen enough where weeks of gains can be wiped out in just a day or a few days here. And I think that'll be the case. If we can get a strong reversal, pretty big bearish candle, a bearish candle right now, again, whether it happens today or on Monday, has the potential to wipe out a week or more of candles right here in one fell swoop. That's a bearish engulfing candle. And if you get a bearish engulfing candle, after a very extended overbought run with other bearish technicals like the divergences on the 60-minute charts, and the 50 coming back to test the 200 and a failure at resistance, like I say, add in all that, and I can tell you that's a pretty big check mark for a short trade that's going to last for more than just a 2 to 3% pullback. So let's leave it at that. Watch to see how the day closes. Again, I'm just laying out potential scenarios. Right now, the market has been resilient, so it may want to come back up, make another run, and even pop those recent highs that we put in on Monday. Okay, and in this morning's charts that I'm watching, again, sometimes I'll make those public content if it's just broad market analysis, but I covered a couple individual stock, some comments on what else was it, crude oil, and I followed up with a post on gold right after that. But I wanted to point out this is what I posted this morning regarding the broad market. And it's the same thing I've been talking about. There's last Thursday's lows. I colored that line yellow. I really think if I hate to use line in the sands where it's bullish above or bearish below, but I do think if we take that out, then it's safe to say that a correction is underway with more downside to come. So again, that is last Thursday's, not yesterday's, last Thursday's lows. That's a level I've been harping on. That's the yellow line. You can see we have also minor support right around here. We've sliced through it a couple times recently with volatility, but there's quite a bit of reactions there. So I see it. I see the market like this, trading in this small, tight, seeing this price compression, a little tight range. It was a little sideways trading range there, pop down there. And I think if we do, and if it happened today or Monday, we're probably going to almost certainly go down and then take out that low. I wouldn't even expect probably a whole lot of fight right there from the bulls. I think we'll just come on down through it and keep going with maybe a minimal reaction. That's my guess. We'll see. That is QQQ. Yeah, NASDAQ 100 futures at least, NQ. Let's look at the S&P 500 futures. Again, same trend line off the lows. We're still below that, and we're still failed to take out that high from Monday. There's Monday's high when we failed right at that those triple top resistance from last quarter, those three highs. And again, you can see there's a minor support level right here that needs to go. And then there's that Thursday's low, it's that yellow line. And let's see how we finish the day. So nothing really has changed much in the technicals. When we really zoom down as I'm doing this video, you can sometimes cue in when you get these clean crossovers on the PPO or MAC. This is a MACD up top. Here's a bearish cross. You get a little, at least the momentum stopped to the upside. You had a small correction to there. You had another, bearish cross right there. There's your little correction. It looked like they were going to cross. See, they kissed. Sometimes the lines kiss, but then they crossed right here, and you had a little correction. So what I'm getting at, here's one right now in play, and that may be the catalyst to bring us down here. And I think we'll get it. I think today we'll see a pretty powerful fade. And I think that's going to, what happens is little by little after such a strong run, it takes a lot to chip away at that bullish confidence. But I'll leave it at this. this market for months now, heading into really since the party started back in early October to the downside, it has been a one-sided market. What I mean, I use the analogy of a crowded boat. Everybody was on the bear side, selling side, whatever you want to call it, but that market was it was an impulsive move down with relentless selling, especially down into the December lows. Everybody was on one side of the boat. Since December 26th, everybody's been on the other side of the boat. And so, look, maybe we have an orderly, maybe all that's done. Maybe that was one of those quick, hey, we had a correction, we had a V recovery, and it's over. I don't think so. I think there's still a lot of nervous traders. And so, if everyone starts flipping to the other side of the boat, we get enough evidence that the trend, at least for the near term, is over. You'll see a lot of profit taking. You'll probably see some shorts that have been beat up and have been gun shy lately to step in. They'll start stepping in, and so I think you can see a pretty swift sell-off. I'm still not talking that meltdown type stuff. That's longer term. That it could come sooner than most think, and that's all I'm trying to say here is just be prepared for the unexpected, because nobody expects the market to drop 5% in a week right now. Nobody even thinks it's going to drop 5%. Most of the people I talk to, at least. From what I can gather. And if it does, remember, it can happen fast. And when you look at a daily chart there, you can wipe out easily. What is this? If we go back here, darn, didn't want to move that line. If we go back here to here, that goes back. There's 2 weeks of candles right there. And I think we could wipe out those 2 weeks of candles in just a day or two, maybe 3 days, depending on how things go, if we get some kind of decent sell signal, which we just haven't had now in a while. We need to get a bearish, some type of bearish candle, undercut those lows from last week, and some things like that. And if not, then watch for the market to consolidate. If it can do its trick again, just like it did back here and here, we had a couple periods where it consolidated, corrected. The charts indicated a correction, and it gave us one. But it was more so, although we had a correction in price, it was more so in time. And then, boom, markets went up, had a little correction to get the fuel for this next leg up. So there's your scenarios. The uber bullish scenario, which I just cannot buy into, is just keep on going like this level's not even there, right on up to new highs with minimal pullbacks. In other words, a trend similar to what we've seen here. This is my most bullish scenario. Consolidate around these levels for a while, even if we punch up through there, work off the overbought conditions, then build up the energy for another thrust up. Or my preferred scenario says we'll come back in, have a decent tradable correction, and from there let's just see how that one evolves if we get it. All right, so first things first, and that's to watch to see how today closes. Will we get that fourth consecutive red candle? If we do, like I said, it'll be one heck of a fade, and it will tell us a little bit more than just, wow, big deal, 4 days, red close in a row. It'll speak a little louder to the, supply demand dynamics, with a pop like this getting faded so hard, if it happens. All right, I will end it there. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.